Hello, my name is Alex Johnson, and welcome back to our limited series Fintech Takes podcast, What Customers Want. This podcast series is sponsored by Ubiquity, and I am thrilled, I say, to be co-hosting it with Corey Besaw, president of APAC and one of the co-founders of Ubiquity. In the first two episodes of this series, we've explored fintech's complicated relationship with customer service, including a deep dive in episode 2 into the actual mechanics of how customer service and dispute management work inside of a rapidly scaling B2C fintech company. In this episode, episode 3, we add yet another layer of complication and complexity to this discussion: bank partnerships. Now, as you know, fintech companies in the US don't operate in a vacuum. To do what they do, they generally need sponsor banks, as well as a whole constellation of other technology and service providers, from core systems to issuer processors. So that's why in today's episode, Corey and I sat down to talk with Ahon Sarkar. Ahon is a friend of mine and the general manager of Helix, a banking-as-a-service platform and core banking system. In his role, Ahon sits in the middle of the intersection of banking and fintech. And let me tell you something. Over the last 5 years, Ahon has seen a lot. In this episode, Corey, Ahon, and I talk about the delicate balance that banks need to strike in helping their fintech programs structure their customer service and support operations, from going from 0 to 1 to scaling up over time, with the goal of maximizing customer satisfaction, creating iterative feedback loops for improving their products, and, maybe most importantly, keeping the bank and their regulators fully engaged and comfortable, especially as the fintech program scales up and grows. Now, my favorite quote from this episode came from Ahon, who said that trust is the integral of your interactions over time. And what he meant was that every interaction that you have with another party either builds trust or degrades trust. And at the end of the day, the amount of trust that you have in another party is the sum total of all the interactions, positive and negative, that you've had with them. This, I think, is the picture-perfect way to describe the current state of fintech generally and banking as a service specifically. We are at a critical inflection point in establishing and maintaining trust. Trust between banks and regulators, between banks and fintech companies, and, most importantly, between fintech companies and their customers. So, without further ado, I am very proud to present episode 3 of What Customers Want. Okay, well, I'm excited for this one. Corey, great to be back with you again. How are you, sir?
Doing well. Great to be back, Alex.
I am delighted to have you, and I am delighted to have my friend Ahon joining us as well. Ahon, how are you?
I'm doing great. It's good to see you guys this morning.
It is great to see you too. I figured that you'd be down for a nerdy chat on all things fintech, banking as a service, customer service. So to start with, I think the thing I wanted to get your quick take on is, in this series, we've been exploring this idea that there are some sort of natural tension points between this idea of providing customer service that is compliant, that meets the expectations of consumers, which don't always totally line up with maybe this vision we have of financial services being entirely self-service and automated. Sometimes people want to talk to a human being. That sort of set of requirements, and then fintech, which moves fast, is constantly innovating, is oftentimes trying to sort of engineer the perfect solution to any problem. I want to add a layer of complexity, though, to this, because in the US, as we all know, you can't really offer many financial services products without also having a bank involved. And this, I think, adds a whole other layer of complication to the problems that we've been exploring in this series, because the bank has a set of responsibilities and they have a role and they have a perspective on all of these questions. So Ahon, as someone who sits very much in the middle of the conversations that happen between banks and fintech companies, at the very, very early starting place when a program is just getting going, you're going from that 0 to 1 place, I'd love it if you could kind of characterize to start how conversations around customer service and support tend to go between fintech programs, their bank partners, and then any other sort of providers or platforms that they might be working with. How does that tend to start?
Yeah, strong opening question.
Thank you.
I guess I would start with, what is your mental map for how banks work with these fintechs, right?
Mhm.
Because I think if you rewinded the clock 7 years, there might be some that say, hey, and this word drives me up the wall, but fintechs are just aggregators for banks. They
Yeah.
aggregate customers and they bring them over, and that sits on one account at the bank. And I think every regulator today will tell you that that is not the mental map that they are operating on. The fintech is an extension of the bank, right? The bank has a
Mhm.
charter, they bring their products to customers across a number of distribution channels, and fintechs are one of those. And so the reason I start with that is because at the most fundamental level, the bank's responsibility is to oversee and understand the way that the fintech or fintechs, when you have
Mhm.
multiple going at
Mhm.
once, the way that they are interacting with the customers, the way that they are delivering their services. And so, in any relationship, whether it is marketing or it is customer service or it is product ideation, etc., the bank has a responsibility to oversee and understand that, arguably more so than if it was them, right? Because once they've established the protocol by which that party can go and engage with the rest of the world, they're going to run, right? And within the frameworks that they've established. And so setting a good foundation at the beginning is so, so critical. And to your question, the reality is, when a fintech shows up to a bank and says, hey, I want to go launch XYZ banking product, we found that typically it branches where there are, at a high level, two different kinds of customers who come into that conversation.
Mhm.
Sometimes, and I will tell you that this is the minority of cases, sometimes you get somebody who's familiar with customer service. Like they have been interacting with the customer for years. And it just so happens that this is a new product they're offering. And if you get really, really lucky, sometimes they already have understanding of financial services and of the nuances of oversight and compliance and broader regulation and of setting up frameworks that work for the customer and that work for them.
Yeah.
And in those cases, the conversation is oftentimes, what's the infrastructure that you've set up? How does, let's say you're in a remittance business today, right? You're
Yeah.
already interfacing with the customer. You're already in a highly regulated space. You're just now working in a different regulated space and having to cross apply those frameworks onto your existing setup. So in
Mhm.
those conversations, typically it's really just about aligning those mental models and the regulatory frameworks of how your existing client success or your existing customer support team are going to work with this new team and where you have shared resources or distinct resources. But as I'm sure all three of us know, the majority of the cases happen when somebody shows up and has never done this in their entire life, right? And so the reality is there is this spectrum of understanding and of experience from a customer service perspective. And as the bank partner, you have to be able to help ratchet up your involvement and guidance when somebody doesn't know what the right starting framework is. And you have to learn how to have the right boundaries in place, but to be able to allow incremental permission if you do have somebody that understands the space really well. So, step one is figure out, where do you sit on this spectrum of I don't know anything to I have an entire apparatus. And then step two is, especially if you are a business that's starting this for the first time, you have a conversation about what 0 to 1 looks like, but then what 1 to 10 looks like, and what 10 to 100 looks like. Because oftentimes it might be different answers. For 0 to 1, the question that a lot of these fintechs are asking is, how do I strike the balance between providing a good experience and not having to over resource my team? Because I get 10 people total. I can't throw 8 people at customer support because I don't have anyone left for
Right.
product and for operations. But at the same time, I don't want you to go onto my app and then have no way of solving your problem and have a terrible experience and churn out, because I know how critically important it is in the 0 to 1 and 1 to 10 phase for you to feel good about the way that you're using this experience, right? And so the first piece is, okay, what does an MVP team look like? What are the expectations for oversight, for visibility, for operating procedures, and even for things like IVR or for phone trees? If you're going to do it by yourself, what does that staffing plan look like over time, and how are you going to ensure that people are trained up and ready to go? And if you are trusting a partner to come in and help you with customer service, well, now you're introducing a third party into the mix. How are you going to ensure that that party has been approved as a critical vendor by the bank? How are you going to ensure that that party has a deep understanding, not just of what you do, but of what the bank does, so that they can play that critical interfacing role with the customer, where the customer doesn't feel like they're being shipped from island to island to island, but rather there's actually a consistent experience? And then how are you going to use technology as your way to communicate with each other, be on the same page, and ultimately give a great experience? So, bit of an all over the place answer, but the net of it is people come in at a different point on the spectrum. If you already have experience, it's about aligning mental maps. If you don't have experience, it's about setting a plan for how you're going to scale, setting the framework within which you're going to operate, and then getting aligned on what that's going to look like on a week to week, month to month basis as you grow your business.
One of the things that, first of all, you brought up a lot of really good and interesting points. One of the things that I think really resonates is the, sort of the framework that a sponsor bank might have, right? And, we work, my teams work with 15, 17 different sponsor banks, and some of them, are major sponsor banks who support, dozens and dozens of programs. Others are just kind of dipping their toes into this and trying to kind of figure out for the first time. I've seen firsthand a lot of clients who are getting started when they're interviewing a sponsor bank, let's say, or selecting a sponsor bank. They're really looking at it through the lens of who is going to be the easiest to work with. Which could also be code for who is going to let me take on as much decision making as possible in this relationship and, kind of frankly do what I want to do. The problem that I maybe see with that, though, is that, there are hazards, right? And I think we've seen sponsor banks who have probably gotten into the business not fully prepared to support all of the kinds of oversight activities that they really need to do. And then trouble comes up. And that's not good for anyone in the ecosystem. I'm wondering, if you were starting up a fintech today, right? I'm just curious, like, how would you look at the selection of a sponsor bank, which is probably together with the selection of a processor, like one of the very first activities that you'd be doing? What are some of the things you'd be kind of looking at in those conversations or that decision-making process?
Yeah, it's a great question. And it's actually not dissimilar from what we do today when we're onboarding a bank of record to be a Helix bank, right? Because yes, we're not going to go build a product on top of them, but we are the technology that they're going to use to offer to those types of fintech companies that are going to go build products. It's a little bit like setting up the foundation for your house. And what I mean by that is you wouldn't go put the pillars in the wall that were the easiest to set up. You would put the pillars in the wall that would be the most likely to hold your house up, right? Because at the end of the day, you want a house, right? And you want that house to be durable no matter what happens outside or what happens in your life. When we look at bank partners, there's kind of a series of questions that we ask along the way. The first is, how much of a strategic priority is this at the bank? If this is a short-term strategy for them to try and get some granular deposits, I got bad news for you, buddy. It's going to take a little bit more work than that. This is not an aggregator model. You're going to have to be pretty involved, and you're likely going to have to be connected all the way up to the CEO in terms of strategic vision. And where we found... Oh, go ahead.
I was saying the board, all the way up to the board. Yeah.
100%. Right? Because in order to be good at being a banking as a service bank, you must invest in the core competencies that you're going to need there, right? You must invest in operational rigor. You must invest in compliance and oversight. You must invest in third-party partnership. You must invest in vendor diligence, right?
Yep.
There are lots of things that become important as a bank of record. So the first question is this a strategic priority? The second question is, have they ever interacted with a third-party partnership type model, whether that is in prepaid banking or white label banking or banking as a service? It's a new operating model. When you're used to operating directly hands-on with your customers and now you're trusting a different party to go extend your branch and your brand out into a customer base, you need to be prepared for that type of engagement. So we do look for, do they have that type of experience? The third thing we look for is, do they have the type of balance sheet flexibility that might be needed for that type of partnership? And do they have the understanding for the types of products that are being offered in the space? Because what you'll find is banks of record can oftentimes sit on another spectrum, right? From relatively conservative to the types of banks that you were talking about before. And really, if I were starting a business partnering with a bank of record, I want to ensure that they're going to be almost an advisor to me as we're building out new products. There's a really healthy tension, I think, between good fintech and bank relationships, where one party is trying to create a new type of product that maybe hasn't existed before, but the other party needs to make sure that that's happening inside of our regulatory framework. The other party needs to make sure that we're partnering with regulators, not letting them find out about the product after the fact, right? And so, similar to a marriage, you're looking for somebody who's balancing you out, right? And who's able to help you fill in the gaps where you might not have them. And I love the fact that you call out, people want the one that's going to kind of close their eyes and let them do whatever they want. Not all friction is bad friction, right?
Yeah.
Sometimes good friction results in a better product experience. And we've experienced that time and time again, where a fintech might come to us and say, we want to build this exciting thing. We bring it to the bank, and then they say, oh, well, we fell into a trap kind of like that 8 years ago when we tried to do this.
Yeah.
Here's the thing that you should go differently, do differently. And in the beginning, when the fintech is contending with the platonic ideal of that product feature in their head, there's some initial friction. But as you unpack that and you get into the why, you ultimately end up with a product that is better for our financial system, better for the end customer, easier to oversee, and that likely still meets the core needs of the fintech, just in a different way. So I'd look for that strategic alignment. I'd look for that existing experience. I'd look for that open-mindedness, but I'd also look for that regulatory grounding.
Yeah, no, go ahead, Corey. Go ahead.
Sorry.
No, please.
I would just add, in addition to the regulatory grounding, I think there's sort of the hard-learned lessons that you pointed out, right? In that example, 8 years ago, we tried something similar. I think people often underestimate the consequences of bad actors within the system on the risk management side, and they assume that all customers are going to be authentic customers who use a product in the way that they intend for the product to be used, when in fact that may not be the case, right? They also underestimate the complexity of supporting certain products and thinking through, okay, but what if it goes wrong? What if it doesn't work out in the way that you expect it to? And there are always going to be edge cases. And I think that's especially true in the financial system, where there are a lot of moving parts and different counterparties and complexities. And I think that experience is something that a really good banking partner is also going to bring to the table in a way that, is maybe just that kind of hard-earned experience that a lot of fintechs probably don't have on their team.
Well,
Absolutely.
And one thing I would add to that, I completely agree with that. It's interesting because I think, Corey, as you point out, like edge cases in financial services are so much more important to think about than I think edge cases in other ones, right? Because in other industries, you can just sort of say, like, we're going to solve for the 80% and the 20% or the remaining 10% or the remaining 5% or remaining 2%. Like, that's not going to kill us. Like, nothing bad is going to happen out there. And in financial services, there's such asymmetric risks that you have to manage that, like, a single edge case can absolutely destroy your entire business. And I think that particularly when we talk about sponsor banks or like banking partners, there is this idea that, like using fraud as an example, you have sort of a network reputation problem, right? Which is that, like, if you're a sponsor bank, a banking partner, a bank of record, you are as sort of strong as your weakest link. And so if you have one program that is operated on your charter, or that you are the bin sponsor of, or however the program is set up, you and your reputation and the value you provide to your customers directly and to all the other programs you might be working with is contingent on that one program operating in a really great way. And whether it's a compliance problem that they might have, or say that they sort of are a little lax in how they manage fraud, or they're doing the wrong thing from a customer disputes perspective, that can create like a cascading problem that affects you at a network level. And suddenly you not only have a problem with that specific fintech program, you have a problem with all your fintech programs. You have a problem with Visa and MasterCard. You have a problem at a very, very different level. And, Ahon, I mean, I'd love to get your kind of take on how things have changed, but that problem can cascade all the way down to the bottom of, regulators saying, we're not really wild about what's happening in banking as a service as an entire like business model. So there is this need to sort of manage reputation at a network level that I would imagine colors the way that banks think about managing the risks when they're working with new fintech programs, and how they take things like customer support really seriously.
You're spot on. It, I think, underscores the importance of setting things up the right way in the beginning. Because if you don't, there is this geometric complexity that you start to experience as you put more and more edge case type partners. Because to your point, in financial services, because of the asymmetric risk profile and because of the business continuity risks of not solving for edge cases, you do need to be understanding what's happening on the perimeter of your offering. And if you don't have a relatively straightforward and standardized framework that you feel good about, that regulators feel good about, that you're starting from, and you're kind of treating each one as a one-off, pretty soon you're managing a business of 15 different one-offs that are impossible to actually oversee, no matter how many people you throw at it, right? Because each time one of these programs branches off another 8 ways, you don't have 8 people to go and watch the different points that's gone and branched off. And you don't want to be in a world where your poor team of 15 people is having to oversee 3,000 of these open endpoints where you're not entirely sure what that interaction looks like. And to your point, in this paradigm, the fintech program, the bank, the overseeing regulatory body, the association, the processor, there's so many people whose reputations are at stake in these
Totally.
types of partnerships that you have to take vendor risk extremely seriously. And particularly when you look at something like customer support, which is the interaction with the end customer, you have to be really thoughtful about what type of experience you're going to be offering, where you put in friction and what is good friction versus bad friction, and what impact that might have on your end business. I'll give you an example that came up like 4 years ago. We had a customer who wanted to give as frictionless of a dispute process as possible. And you're smiling because I'm sure you know where this goes, right? What do? They say, well, I'm getting a ton of call volume in my customer support kind of path. And so I want to have less call volume and I want to get my customers a faster path to resolution. So what do? Well, they raise the auto decision threshold on a dispute from $30 to $100. And so for those of you guys who aren't deep in the dispute world, all that means is that now if you dispute a transaction under $100, it will automatically get approved. Well, for the first couple hours of doing that, felt great, right? Call volume was coming down. You weren't seeing a large number of disputes until someone triggered the edge case, right? Somebody realized, hold on, this company has an auto dispute threshold of under $100. And suddenly you started seeing $95 dispute after $95 dispute after $95 dispute. And in financial services, particularly in the digital world that we live in, that spreads like wildfire, right? That goes from one party to another party, to a group of parties, to a Discord channel. And you are as equipped as you can respond quickly to that type of action. But that's the type of case where ostensibly a higher dispute threshold gave the customer a better experience. It also cost you a ton from a fraud perspective, right? It also cost you a ton over time from a reputation perspective when you had to whipsaw how you were handling those types of disputes. And so, to Corey's point, when you're partnering with someone, be it a technology provider, be it a customer support provider, be it a bank, you want someone who's seen that before, so that when you come to them and say, I want to raise my auto dispute threshold to $200, they can say, I'm not going to tell you can't do that, but I am going to tell you what will probably happen if you do that. And so as long as you're aware that that's how you're going to think about it, there are protocols that we can put in place to let you do that, but there's substantial risk, and chances are you're going to back off, right? It's a little bit, Corey, when you were explaining why that's so important, I had this mental image of like a Sherpa helping you climb Mount Everest, right? You're not going to go find the cheapest or fastest Sherpa. You're going to find the Sherpa that's done this for 12 years and that has seen all of the different kinds of edge cases. So when you're like, isn't that a way shorter path to the summit? They're like, nope, that's super slippery. Do not go that way. Right?
There's a lot of dead bodies over there. Yeah. We don't want to go that way.
You don't want to see what's on the other end of that ridge, right? And you're like, thank you. And you waste your calories going the other way, right? And so, similarly, I think as you understand that, hey, all of these parties need to ensure not just the integrity of their own reputation, but also the integrity of the financial system, right? When we are offering banking products, we are extending the framework of the United States economy out to end customers, and we are representing the way that that financial economy is supposed to work. And so it's that Spider-Man quote, right? With great power comes great responsibility. If you're going to go and change the way that customers are interacting with these types of products, you have to hold that responsibility, and you have to represent that responsibility, whether you are the bank or the technology provider or the fintech in the arrangement.
I think looking at the big picture and thinking about how regulators might be looking at risk, one of the ways that regulators are kind of guided is by complaint volume, right?
Mm-hmm.
A lot of times it's consumers that are telling them where to look. And the reality is that consumers rarely go directly to a regulator. Typically, they are giving a company a chance to make things right. There are exceptions there. We work with our clients to do a lot of analysis on regulatory complaints, as you can imagine, but it's pretty rare that a customer is truly going directly to a regulator. And so I always recommend to my customers one of the most powerful tools that exists to really understand, importantly, what your customers think about what you're doing is customer satisfaction survey, and looking at things like Net Promoter Score, customer effort score, first contact resolution. We know that there's a direct correlation between these things and the complaint volume that gets generated. And it's not all about the downside of complaints. There's also a direct correlation between customer churn or customer attrition and these elements. So, not only do you want to manage these for regulatory risk mitigation reasons, you want to manage them for business reasons. And I do think it's something that a lot of people, as they get started, might tend to miss out on, right? And, it's just such an important tool that allows you to kind of discover edge cases that you might not even know exist, and discover things that cause real customer friction where you assumed or believed that there wasn't any. So definitely something I'd recommend looking at.
Well, and the beautiful part of that, and oftentimes I notice across companies that are not used to this, that this connectivity doesn't exist in the very beginning. There should be tight connectivity between your customer support team and your product team, right?
Yeah.
Because the first step is, hey, I'm not measuring anything. How do I get to measuring CSAT, NPS, understand where my detractors are, understand why those detractors are there, and get my CSAT to a great place? But then the next step is, okay, my CSAT is in a good spot, my NPS is in a good spot. But what are the types of issues that my customer support team is dealing with telling me about my product? I'll give you an example. We had a situation where this customer had a very high NPS, very high CSAT. You would say it would be world class, right? And it's easy, I think, when you're in that position to say, okay, it's good, we're good, things are good, right? Until the leader went and looked at the actual types of things that were coming into their team, and they noticed that 574 times that they were getting a phone call to go change a travel setting. They're like, hold on. Why haven't we built this into the product? Like, why are we manually going and trying to resolve this with this one person over in support when really this should be a product feature? Well, the honest answer was because that wasn't on the product team's mind. The product team isn't seeing the customer support tickets. The product team is thinking about what's the next fancy thing that we can go roll out in consumer banking. And sometimes it's those things that really make a difference, right? It's I forgot the name of this phenomenon, but it's like when you have a path along a park, but then there's like a human-made path, which is like the path that people end up walking, right? And as a designer, as an architect, you have to look at that and say, that's where the path should have been, because that's really where my customers were taking me. And so to your point, there is this lifeblood connectivity between the team that is the interface with the end customer that may not be doing client interviews and may not be doing the types of sort of like requirements gathering that you traditionally do in product, but that is actually giving you some of the most valuable signals about what would actually make your product a lot more useful to end customers and what types of functionality would help unblock not just them, but also your own team. I'm sure that Steve doesn't want to be changing travel settings. I'm sure that every time he gets one of those tickets, he's like, oh, really? And then he goes in and he tells them, okay, they're going to Antigua, right? But the moment you put that feature in, suddenly Steve's a lot happier. Every single one of those customers are a lot happier. And your business is running more smoothly because you're not wasting operational time on something that should have been self-service.
And customer service, by the way, presents an excellent data gathering location for that because, all too often product teams will have a backlog of things that they're interested in building, but they don't necessarily know what's more important, right? So someone
Right.
has to make, kind of subjective decisions based on what they think is most important. But, and especially with a product that's starting to scale, there's so many interactions happening between customers and customer support professionals on a daily basis. That's an excellent source as long as you're doing the work of analyzing those contacts and understanding root cause and putting that together in a format that translates to a product team. There's so much data that exists there that can really tell a product team, look, these are the things to focus on, right? But I think that is very easy to miss, right?
Yeah.
And that link is very often not there.
Especially in cases where your NPS and CSAT are already high. You already look good. You
Well,
can already tell your boss it looks good.
that is such a good point. I hadn't really thought about this idea that like from the customer's perspective, as long as I get my problem solved, I'm happy, right? Like
Yeah.
problem solved, it's all good. Like I kind of thought it would be in the app, but it's not. But I had to call and they fixed it for me, and it's not a big deal. Like there is a less efficient way to solve customers' problems that can still keep NPS scores and
Totally.
customer satisfaction scores high. But to your point, that doesn't necessarily mean that it's the optimal way from a business perspective, from a product perspective, or even from a customer's perspective to solve that problem. And so, yeah, that idea that like don't be lulled to sleep by your high NPS or customer satisfaction scores and necessarily assume that everything that's making its way to customer support needs to be there is a really, really good point. The other thing I wanted to ask you about is I kind of feel like everybody who studies this stuff sort of looks at it through the lens of their own life, right? So
Sure.
my friend Kia Hazlitt, she's a soccer referee. And so she tends to think about all these types of topics in terms of like, how would a referee handle this? I have young kids at home. And so I tend to think about it from sort of a parental lens. And one of the things that I have been experiencing recently as a parent that's terrifying is that my oldest son is now old enough that he can like do stuff for my younger kids in sort of a parental kind of capacity. And it's very scary, right? Because my daughter is, 17 months old and my oldest son is 6. And so he can like pick her up and carry her and help her solve problems. And so it's cool and it's useful. But as the person ultimately in charge of everyone's safety, it's also very scary to watch, right? And like, I'll look out the back window and my 6-year-old is putting my daughter on the trampoline and like lifting her onto the trampoline. And I'm like, and so like it's I love your intention. I love that you're trying to solve this problem, but like I don't think we're quite there yet in terms of how we're
Yeah.
splitting up these responsibilities. So Ahon, a thing I'm curious about is particularly not just when you're getting started, but as you start to kind of scale up, how do you see banks approaching this idea of sort of letting go of certain things, right? And like and infusing more trust and more responsibility into fintech programs as they scale up and they hit these milestones where it's like, okay, yes, we think that you have the right process here. As you scale up, like we don't want to be a bottleneck or be in your way. But I, like me watching my kids in the backyard, like I also really do still want to know what's going on. Like from a best practices perspective, how do you see banks handling that? Because that would seem like a very delicate handoff process in some ways.
100%. My wife is pregnant right now, and I'm thinking about the context of what you're talking about.
I'm trying not to scare you, man. It's so fun,
prepared,
but
right? I better get prepared. Well,
it is scary.
And the truth of the matter, right, is that first of all, for all my calculus nerds, trust is just the integral of interactions over time, right? Every interaction either builds trust or decreases trust on a consistent basis. And that's true whether it's customer support or it's true whether it's your bank relationship or it's true whether it's your marriage, right? It doesn't really matter. Your trust with somebody is the integral of your interactions with them over time. However, you may trust someone and you may want to give them some degree of latitude, but you may have a responsibility that makes it such that if you're going to let them go out and do what they want in the world, you have to put some guardrails in place, right? So you may have built trust with your son over the years where you're like, okay, I'm comfortable with you picking her up and putting her on the couch. But you may close off the trampoline because you know that like even if you trust this kid, one, he's never really put a child on a trampoline before, and he may not understand the implications of the trampoline.
Right.
And so
the physics are a little different. Yeah.
right. And so at the door, it might be locked, and there might be a sign that says "Call Dad." Right.
Right.
It's not that you can't go on the trampoline. It's just that if you want to go on the trampoline, let me help you with that process. Right. And so similarly, we've had the benefit of seeing some fintech bank relationships that have evolved over 7 years, right? Which in the BaaS world is an eternity, right? And when those relationships started, the company was relatively nascent. The bank was relatively early to banking as a service. And over the years, the team staffed up, the bank staffed up, the bank brought a bunch of new partners in, the fintech started offering a whole bunch of new products, and the bank started to understand, hey, these kids can be trusted near the trampoline. These kids can't yet be trusted near the trampoline. And they've shown me that. But you as the parent, have another body, in this case, the regulator, right, who's looking at you to make sure that you're parenting your kids in the correct way, right?
And so, don't think that I don't think about Child Protective Services.
I was like,
and
bring a CPS
no. I mean, I do think about that honestly sometimes, where I'm like, how would I explain this if this was to be a conversation later? And it is in the back of your head, right? So no, keep going.
Exactly. And so as that bank partner, you have to say, one, what are the safeguards that I'm going to put in place so that I know that if I was the one offering this or I was the one doing this, that I would be comfortable with explaining that to a regulator?
Yep.
How am I going to educate this party as to the importance of what those safeguards are and why it's going to impact their business? And then, honestly, I know we don't want to talk about technology. How do I ensure that that is memorialized, right? So that every time that this party who's out in the world doing stuff does stuff, it's recorded. And if I want, I can go check. So maybe it's the Ring camera in your backyard, right? Maybe it's the lock on your trampoline. But you have safeguards in place to ensure that the actors are acting as intended. Because it may be that until now, I've built a good amount of trust with you, but one negative interaction can dramatically change that overnight, right? And we see that all the time in society. And so, you want to set them up for success. So you don't want to put them in a position where they can go create a ton of risk for themselves and degrade that type of trust. And so what we've seen really good banks of record do, and I'll tell you in the beginning, the fintechs are frustrated by it, right? The fintech comes to them and says, hey, I saw this massive corporation who's been doing this for 10 years do this one type of feature that creates a better customer experience. I'll give you an example. I saw this party go and offer instant availability on their ACH transactions, and my customers are frustrated with how long it takes them to get their money, and I want to be able to offer them instant ACH too, right? It's like, okay, well, your program has 1,000 customers, and you have not yet totally understood whether that customer has those funds. You don't have like a safeguard in place to check, okay, does their external account have a balance 1.5 times what they're pulling in? Or is there risk that they would actually go and return that ACH? We would give them the money, and then now you're on the hook for the entire payment amount, right? So the bank will come to the party and say, hey, it's not that I'm opposed from giving instant availability. It's that if we want to safely give instant availability to the customer, we have to make sure that we know that there's enough money in the account. We have to make sure that maybe this consumer has connected direct deposit, or there are other risk offsetting variables that make us comfortable with saying, hey, you know what? This customer has built trust with us over time. You, the partner, have built trust with us over time. We have the safeguards to know that there is money in the account. We have the safeguards to know that they are getting their paycheck into this account. And so is there risk? Yes, there is still risk, right? There is still risk that a good person suddenly changes or their account gets taken over or something like that. But that risk surface is so much smaller than it would be over here. And because of the trust that you've built, because of the trust that customer has built, we're comfortable with this risk profile, and we can explain to our regulator, or in your case, Child Protective Services, what that risk profile was, what mitigating factors we had in place to ensure that we weren't going to end up in that risk factor. And let's pick the worst case scenario. Let's say we did that, and then let's say we suddenly saw a whole bunch of customers that were still fitting in that. We have to be overseeing that and have the wherewithal to say, oh, pump the brakes. Like, clearly, this risk profile that we thought was this big is actually this big because of edge cases, right? And so now we have to make sure that we have mitigating factors in place for those edge cases, right? And so I love your trampoline analogy because it's not that different, right? You're like, okay, you can lift the baby from in this square radius. I will have a Ring camera that will alert to me when something weird is happening, and I'll lock off. I'll close the garbage disposal. I'll lock off the trampoline, right? And I'll just make sure you can't hurt yourself so that you can have some degree of autonomy, because where you can overcorrect here is to put your kid into a 2x2 pen and say, you cannot walk outside of this, because that's a pretty tough existence, right? And as a
It's
fintech
what I
company,
want to do as a parent, but no, you're exactly right, because it's like the alternate factor is I want them to turn into the best possible version of themselves. That's
right.
ultimately the project we're working on, and I think to translate it into a banking as a service or fintech context, like banks want their fintech partners to be outrageously successful and to innovate in ways that they couldn't possibly do on their own, and to bring new value to customers into the market. So like we want that ultimate success. And so finding that balance on trust is extraordinarily hard. I will say my wife is probably loving this conversation if she's listening to it, because she told me specifically that introducing the trampoline was introducing a big new tail risk to the whole process. And so she's not wrong about that, although I think we have gotten a lot of enjoyment out of it as well. Corey, I mean, you sit on the other side of helping banks and fintech companies manage this. What's your perspective on how that like balance needs to be struck?
Yeah, look, I think that the idea that fintechs might initially dislike the creative friction that gets introduced by strong banking partners, I see that, but I also believe that's a good thing, because it lends the value of experience and oversight. And the reality is that, it can feel sometimes, maybe that, that the parties are on different sides, but that really isn't the case, right? Because if the fintech wins, the sponsor bank is also winning.
Mhm.
They're benefiting from the innovation. And by the way, they're sharing in some of the risks of introducing new features without the right guardrails, right? I think everyone truly is on the same team. I guess what I would say is that, in my experience, some of the stronger sponsor banks tend to, have a very different relationship with fintechs on day 100 than they do on year
100%.
2, than they do on year 5.
Yeah.
And that's kind of the thing that if I'm looking at a relationship that I'm looking out for, right, is you want to see that evolution. And what does that evolution mean? Well, it means that the sum of the interactions has been positive and trustworthy, right? But I do think that strong sponsor banks also typically do sort of a random sampling of,
Yeah.
things like disputes, especially, or KYC, or, all kinds of things like that, right? Maybe even looking at random customer service interactions,
Mhm.
or just looking at some of the metrics on the back end. But again, there's a huge variety of, kind of situations in the industry. And, I've certainly seen sponsor banks never ask those questions, never look for random samples, never ask what the customer experience looks like, or, the health of the dispute program, or, tell me more about how KYC is being handled. And to me, those are kind of red flags, because that's where you see that, trouble is probably brewing. It could all be well intentioned, but, if the banking partner, the fintech, and whoever is actually doing the work on the back end, a company like Ubiquity, if there isn't good alignment there, that's not good. So I'm constantly actually encouraging, bank partners and fintechs to engage in a productive way. And interestingly, sometimes, and I'm sure you're in the same boat here, sometimes you end up a little bit in the middle of that, conversation as well. And it's kind of an interesting place to be, because you're really kind of saying like, hey, wait a minute, I see your point. I also see your point, but actually, we have the benefit of having seen this interaction play out hundreds of times in a lot of permutations. So let me give you the benefit of, kind of perspective here. And that conversation, I think, sometimes it's delicate, but it can be really, really important to have. And I find that in a lot of cases, both parties who might have kind of come into a certain scenario, like on very opposite sides of an issue, and just completely not understanding where the other party is coming from, often with a good discussion, you can get people to kind of say like, okay, I can see what you were trying to accomplish. And, oh, I can see why you were warning me about A, B, and C. And that's probably where you need to end up. And at least for me, I want bank partners and fintechs, and some are directly my clients. Sometimes it's only one side, but I want both parties to be in a sustainable business. And I think we should all want that in the industry, because otherwise, to an earlier point, regulators eventually might look at it and say, like, hey, this whole banking as a service thing, maybe it's just not working for us. And that's not in anyone's best interest, not the consumer's best interest, certainly.
Certainly. I mean, it's interesting you say that, because one, that role, particularly in the conversation piece of it, is not unlike a therapist, where you're really just trying to understand and empathize with both sides and then help them connect with each other on what is that
For
middle ground.
sure.
And I think you're really right in that if you regulate yourself, you're unlikely to be surprised, right? Because what you described, random sampling on KYC, random sampling on disputes, understanding, that's what your regulator's going to do. Because what they're trying to do is the same thing that you should be trying to do, which is make sure that you're handling this in a safe and responsible way. And I was chuckling a little bit as you were explaining that, because it ties to a lesson that we learned, honestly, right? So when we first built Helix, and we built it for this model, right? Multi-bank, multi-client, all that kind of stuff. And we're a core system, right? Unlike some of the middlewares out there. So as a core system, we had, in the beginning, we had four roles, I think. We had the bank role, right? Which is kind of, hey, you can kind of see everything. We had the Helix role, because sometimes we have to come in and adjust parts of the system. We had the fintech role, which had a pretty fixed set of capabilities, if you will. And in most cases, the bank needed to come in and do what the bank needed to do. And then we had the auditor role, which was like God power, right? You come in, you could see anything. And we thought that would be sufficient, right? Back in 2016, 2017. And then what you described happened, which is on day 100, the relationship started to change a little bit. On year 3, this party had dramatically matured and had a whole bunch of other risk vectors. And suddenly there were things that used to be squarely on one side or the other, like manual review of KYC, that now the bank was saying, hey, it's been 3 years. I see that you have more sophisticated risk vectors than most large-scale financial institutions. Maybe I'm okay with you doing manual review, right? And then you started to realize that, I look at a bank like NBKC, for example, who's one of our partner banks. They have more than 10, 15 different programs that are wildly different in terms of how new they are to banking as a service, how much they've touched financial services, all that kind of stuff. And so, I joke that, from a marketing perspective, this is one of our least exciting features, but from an operating perspective, this is one of our most exciting features. We ended up completely rewriting our permissions system inside of Helix to be what we called, granular user permissions, where you could define the role, and then you could go and set those roles up with a certain level of controls, and you could adjust those roles over time. And so it became a way to both memorialize and enact that existing state of the relationship, right? So as the customer became a lot more sophisticated and they wanted to start taking on more responsibilities, and the bank knew that the technology system would show the controls, the audit logs, the changes that different people made, and flag when anonymous activities happened, they could say, okay, well, we'll create for you specifically as this program, we'll create this type of role, we'll document for our regulators the type of controls that we have in place. And now my staff doesn't have to go do that manual review for your program, because I can trust you, right? Now your son can go grab the bottle of milk. You don't have to go do it, right?
Yep.
Just because he can't go on the trampoline doesn't mean he can't grab the bottle of milk, right? And so
Yep.
it's interesting, because we learned that as technology providers, we are both almost the notary of their relationship and the therapist for their dialogue, right? Our job is to make sure that both sides feel heard and understood, and that they can connect and find that middle ground that really helps both parties. And then to ensure that the technology implements that and makes it easy for them or Child Protective Services to come in and take a look to make sure that things are happening the way they're supposed to. Because at the end of the day, as a technology provider, you must verify, not trust, right? Despite however much you might trust your different parties, you must assume, to Alex's point from the beginning of this, at all times that there is a bad actor in the mix and that they could go and try and do something negative, so that you close the trampoline door, so that you have the camera in place, and so that once the system is in place, the parties can do what the parties are supposed to do without fear that they might turn on the garbage disposal, without fear that they might go do something that they're not supposed to do. And that relationship, to Corey's point, can change over time. It can go from being the bank is going to do anything that touches regulatory and compliance items to maybe you can do manual review, to, maybe you can have slightly different account limits per product because you've built out that sophistication. Or maybe you can have early or instant ACH availability for this subset of customers. And that's the magic, right? Like that's where you start to have really valuable partnerships, is where you have a mutual understanding of what you're trying to accomplish and what your roles are, and that you're constantly revisiting that as both businesses evolve.
So to wrap up, I couldn't agree more with what you said. And by the way, great job tying all of our insane analogies together very neatly.
Dude,
with
I'm
a
here
bow.
for it.
That
Yeah.
was that was amazing. That was amazing. Normally, I just let them like float out there and just be like, "Yeah, we've moved on from that." So very well done. I will not be quite as artful, but to wrap up, I think the question that I want to get both you and Corey's perspective on is how things are going to evolve or change from here. Because I don't think we can talk about customer service and customer support in the context of banking as a service without acknowledging that a lot of people in the market have sort of seen what the worst case version of all of this could look like, where literally I'm calling the fintech company, I'm calling the bank, I'm trying to find out where my money is, I'm trying to get access to accounts. No one can answer my question. No one can agree on the basic facts of like where my money actually is. And we've already seen regulators take some steps to try to, I would say, sort of bring the floor up a little bit in banking as a service. I chuckle a little bit at the so-called Synapse rule that the FDIC has proposed, which is really just like the most basic. Everyone should have been doing this already. It's kind of terrifying that we need to have a rule to say don't do this. My dad used to joke about my younger brother, being like, you had to actually tell him not to do every single thing that he might do. Otherwise, he would do it and then go, well, you never told me not to. So I guess that's the equivalent of what's happening right now in terms of raising that floor. But Ahon, maybe we can start with you. When you look kind of forward and think about what's happened, how the space has evolved, how it's changed, I think how it's matured and how it's continuing to mature, what do you think the future of how this is going to work kind of looks like? What are the dynamics that you're looking for? Because as much as I think we can accurately describe where we've been over the last 5 to 10 years, where we're going is that much more important.
Absolutely. I think where we're at now, in some light, is an inevitability. In that, you go back to 2016, 2017, banking as a service doesn't exist. Players like us and others come onto the market. The space starts to grow. About 2019, everyone gets really excited about banking as a service. Money starts flooding into the space. Everyone starts launching a product, regardless of what your business model is. As we turn into 23 and the macro environment changes, suddenly it's like, wait, are these good businesses? And then suddenly the load that starts to get put onto shaky foundations starts to crack those foundations. And now what we're seeing is the breaking of some of those foundations. And I almost hesitate to say this because I don't want to come off as insensitive, but it's important that we see what happens when we do it wrong. And the reason I say that is because in 2018, we were highlighting some of these risks to partners. And honestly, no one had ever seen something like this before. And so what they were looking at...
I was yelling about it in my newsletter. People are like, you're a crazy person who doesn't 100%. Make any sense. Like, what the hell are you talking about? This
You're
is
crazy until it's obvious. That's what I've learned in this space, right? You're crazy.
Yeah.
In 2017, when we were trying to sell banking as a service, people looked at us like we were crazy. And now it's obvious. Now it's like, of course, people are going to want to launch banking products, right? And it's like, it's like the Bane quote: "You either die a hero, or you live long enough to see yourself become a villain," right?
Right.
You either die thinking you're crazy, or you live long enough to become obvious, right? To become like we've been saying this for years, right? And so, at some level, until the kid falls on the trampoline, society doesn't realize that maybe we should have rules around who can be on a trampoline and who cannot. No matter if there was someone on the corner saying the whole time, don't let kids on the trampoline, don't let kids on the trampoline.
Right. That looks
doesn't
a little
matter.
dangerous.
That person seems like a heretic, right?
Yeah.
Like, we want to make sure that people have good experiences. So we're going to let kids on the trampoline until somebody breaks their leg, right?
Yeah.
And then suddenly we realize, wait, there were consequences to this, right? And sure, that person might have been saying it, but at the end of the day, we all need to collectively understand the consequences of doing this wrong. But I think we have to zoom out and say, well, what does it look like when this is done wrong? And what does it look like when this is done right?
Yeah.
To the point earlier around what is the future of banking as a service? Well, when this is done wrong, we're seeing it, right? Customers can't access their money. They're misled about insurance claims. Like, there's substantial risk that has fallout effects for the broader economy. And so it's super important. And I think we're all realizing how important it is to have those guardrails in place. And that might mean that certain business models or certain architectures or certain low oversight doesn't work anymore. The floor has been raised, to your point. But when this is done really well, it's helping consumers who are living paycheck to paycheck get access to the cash in a way that doesn't make them go to predatory lenders. It's
Yeah.
getting rid of the $300 in annual fees that a family can't afford to pay but has to pay to access their banking services. It's allowing people to have their context understood and to have products that consider that context and help them go on their journey. And so you have to, and in the case of your son, it's having someone who can help you with some of the smaller tasks, like bringing milk to your daughter, right?
Oh, it's
And
the
so
best.
the question ultimately becomes, how do we preserve the things that are so beautiful and great about this, that actually, to Corey's point, help the bank, that help the client, that even help the regulator who are trying to bring these services to more underserved folks across the country? How do
Yeah.
we preserve that while putting the mitigants in place for what we know to be the real risks of this type of model? And so I really feel for all the customers that are going through the pain in that situation, because they shouldn't have had to break their leg in order for the whole system to change.
Right.
But sometimes that's the catalyst that creates the world that we want to see, right? And so what makes me excited is, sure, the so-called synapse rule is a small and seemingly obvious step of, hey, maybe don't put our 16-month-old onto the trampoline. But
Right.
sometimes
Right.
you got to say it, right? Sometimes
Yep.
you got to say it just so that we're all
Yep.
clear. And I fully expect that that bar is going to keep coming up, and it is
Oh,
a
yeah.
great thing that that bar is going to keep coming up, because once we're all on the same page about the rules of the game and the way that we can play, that's when creativity really starts to come out, right? Where you shouldn't be getting creative on the level of oversight you have. You shouldn't be getting creative on, the fraud controls. You should be getting creative on how, given the foundation of the controls, et cetera, that you have in place, how you can give that customer a better experience while ensuring the integrity of the underlying system, because that's what banking has been wanting. That's what banking has been asking for at some level. And so what makes me really excited for this, I think that you're going to see this regulatory paradigm continue for the next 12 to 18 months. But what makes me really excited, and we're seeing some of this already, because as you know, as a platform, I'm sure, Corey, you're seeing this too, you end up experiencing these things about 18 to 24 months before they actually happen. What we're seeing now is, whether you're a bank who's getting into this space, or you're a fintech who's building in this space, or you're a third party who's integrating into this space, having that baseline set of ground rules for this operating model, not for the old banking operating model, but for this operating model, allows for the right constraints to breed the right kind of creativity. And so I'm excited for the second wave of banking as a service, which has that baseline of what responsible third-party relationships look like in this model, and then can innovate on what that experience looks like, what that customer support touch point looks like, what the product flow is that really helps that customer without introducing more risk into the ecosystem.
Couldn't
I
agree
think
more.
one of the things that I've seen kind of firsthand in conversations is sometimes people will kind of look at it and say, like, well, if a regulator hasn't told me that this is an issue or called this out as a problem, I guess then it might be okay. To take the trampoline even a step further, maybe a painful step further, I think one of the problems is sometimes the regulator isn't even aware of the trampoline, so they can't begin to imagine how they might regulate some
Right.
trampoline, right?
Yeah. Yeah.
Because innovation happens so quickly, and because there are going to be some parties that are more likely to take risk in the system and more comfortable with risk, and kind of might take that approach, like, hey, I haven't been told not to do it. It's probably easier to beg for forgiveness than ask for permission, so let's just go for it. But again, I think recent events have really underscored the risk of that approach. And I'm already seeing more conversations, more proactive conversations, including from bank partners who historically have taken a more permissive approach towards, letting fintechs kind of operate as they will and as they desire. And I think that's a good thing, right? Because it is bringing in that kind of A, natural tension, but B, shared experience, and C, maybe getting the conversation to the point where it's like, yeah, we're actually all on the same team here. We're trying to accomplish the same thing, but let's make sure we do it in a way that doesn't destroy either or both of our business, right? Again, good for all of us. I think that the best model and some of the most innovative fintechs are also some of the largest fintechs, actually. Some of the features that have been widely adopted and customers routinely say they love didn't happen from a very small fintech with a very small partner bank who was willing to try something wild. A lot of times there are features and kind of product ideas that were introduced by a larger fintech and an even larger sponsor bank. And I think one of the reasons for that is they put out a product that's fully baked, so to speak, can stand up to scrutiny, edge cases were thought through, a credible plan to scaling the operation that's going to support the delivery of that product feature has been thought out. And someone had the foresight or wherewithal to maybe even reach out to a regulator proactively and say, you know what, we're thinking about doing this. There's really no regulatory guidance. And I'm aware that regulators are rarely going to give, a definitive answer in that case. But I do think that the best banks have built relationships with regulators where they're able to kind of discuss, ideas and product features that, are new and maybe, are eventually going to be subject to scrutiny. So why not try to bring the regulator in from the beginning? I think we're going to see a lot more of just those kinds of partnerships, those kinds of conversations. And the net of it is we're going to see a lot more fully fleshed out, fully thought through products that actually are sustainable. And that's really the key, because if it's not sustainable, it's not good for the industry. It's not good for the sponsor bank, not good for technology companies, not good for the fintech, most of all, not good for consumers who end up opening, accounts that they actually really like, only to find out that it wasn't sustainable and the fintech shuts down after 6 months. So, I think there's going to be less of that and more sustainable innovation, which I'm really excited about.
Yeah, it's incredible that a conversation on customer service, fintech, and banking as a service in this exact moment ends on such an optimistic note. But I totally agree. I mean, I've been telling people over and over that I'm super bullish on this space in 2025, because I do think, to Ahon, to your point, there is a catalyzing effect that these kind of things have. And I think the learnings that good actors and people who've been approaching this the right way have been building slowly over the last 10 years are really going to crystallize into kind of a new playbook that I'm excited to see what comes out of it. We will leave it here, although we could certainly go a lot longer. I need to let you guys get back to your day jobs, or Corey, in your case, your night job. But I will very happily be back with Corey for episode 4. Ahon, thank you so much for joining us. This was awesome.
It was a real pleasure. Thanks for having me on.
Thanks for tuning in to What Customers Want. If you enjoyed today's episode, don't forget to subscribe and leave a review. We'll be back next Thursday with more insights on what truly matter to customers. See you then.